Hello, everybody. Welcome back to the Mouthy Money podcast. This week, we've got a couple of topics coming up, but we've got kind of one which is going to probably dominate discussions today between Chris and I. Obviously, joined as ever by Chris Jute, Head of Consumer Finance at communications agency MRM. Chris, hello.
Hi, Ed. How you doing?
Yeah, good. Thank you. As I said, we've got kind of one big money topic that really is dominating news media this week. It's the thing that everybody's watching and wondering about, and that is how investment markets have kind of gone suddenly a little bit to hell in a handcart, shall we say? Is that a fair...
Markopolis, I'm calling it.
Markopolis. I'm sure. Come on, Chris. We've get some spin out of you. Let's have a bit of a brainstorm before we start with
That's all I've
ones
got.
about-
I think
Oh,
just
no.
that's all I've got. We need to get the whiteboard out. I'm not sure the listeners need that.
So, what's going on? Not to find a point on it, markets have gone a bit kind of crazy in the past few days. I think it's been much worse in some bits of the stock market than others. So if you look at places like Japan, has been getting kind of massive 12% crashes and then 9% rallies and all kinds of stuff. It's all a bit all over the place. And it's all kind of reminiscent of when things started suddenly getting a bit crazy during COVID. But the reasons why are a bit more opaque, right, Chris? It's a bit more...
It's a bit strange one because it seems like COVID was obviously a big major event, which was pretty obvious as to why investment markets went into full retrenchment. The economy shut down and people couldn't trade, and that's going to have a major knock-on effect to what people invest in and return. So, although painful, that was logical. Whereas this, it seems like there's been some slightly less optimistic jobs data that's come out of the US, is one of the main theories behind this. And that has just spooked global markets that the world's largest economy is going to go into a recession. That the US might already be in a recession or heading towards one, and therefore that's going to lead to a downturn, which means that perhaps some of these stocks are overvalued at the moment and are heading for bumpier ground. Adding to that, some chat around some of the tech stocks that you would have heard of, dear listeners: Apple, Nvidia, other people, Tesla, perhaps reaching the zenith of their kind of prices. Maybe, don't know. I'm definitely not an expert on that, but I've read speculation to that point that actually maybe they're kind of reaching the top of their boom, and so prices are too high and they've had slightly more disappointing sales figures and things like that. Add all of that into the mix, and you get people starting to panic. And yeah, we've seen major losses, haven't we? We saw major losses on Monday. Today being Tuesday, there's been a bit of retrenchment and things will start to claw their way back. But yeah, it's interesting times watching it all play out.
There's a couple of kind of, you touched upon it there, but there's a kind of a couple of specific things that are happening. Obviously, we had the Fed, the US Federal Reserve, which is the central bank in America, basically came out on Wednesday and said, we're not cutting rates just yet. I think it looked like they were going to do it in September. And I think that sort of started worrying markets a little bit, and then we sort of started...
So why would that worry them, Ed? Just to be clear for listeners.
So, when rates stay higher, equities tend to do worse, and then it's created a disconnect where markets think a recession is coming, and that's where we saw the employment numbers on Friday that really triggered stuff off. Because markets think the Fed is doing one thing, but actually the economy is saying something else. So we're going to end up in a situation where the economy is in free fall and the Fed is playing catch up. And that just leads to kind of panic, and everybody gets very, very worried very quickly. But there's a technical thing here as well that's also had an effect. And this is, bear with me here. This is a technical kind of investment thing. And this is not something that normal people are doing, but it's what's called a carry trade, and this is why Japan in particular has been hit hard. So what will happen is big investment institutions, financial firms, whatever, will go to an economy like Japan where interest rates are really low and they can borrow money really, really cheaply. They'll then take that money to an economy where interest rates are much higher. So they will take that to the US, and then they will lend that money out to, I mean, whoever, businesses, people, whatever. And the point is that because interest rates are higher in the US, they basically get to cream the relative difference in rates off the top of that. So they're buying cheap money and they're selling that money on more expensively, effectively, in a nutshell. I'm sure people out there will tell me I'm absolutely obliterating this with oversimplification. But that's basically what happened. Anyway, what started happening as soon as all this sort of jitters started appearing, and so we had the bad jobs numbers through, and then investors started looking at it and said, well, the Fed's saying one thing, but actually the economy's saying something else, so the Fed's going to have to slash its rates. And the first thing that comes to mind is, oh, we're going to have to unwind this carry trade. So it's basically like Fed's going to slash its rates. It's no longer going to be good for us to be borrowing at one rate and, and lending at the other. So we're just going to, dump out of that position, basically. And that's what sent Japanese markets absolutely wild. And that's had a kind of a knock-on effect everywhere else. But then, as you said, we had the kind of the tech stock thing in the mixer, where we have this kind of like, it's dot-com bubble-esque situation developing. So the dot-com bubble, to put it into kind of context, was the internet came along in the late 80s, early 90s, mid 90s really started taking off. And in the late 90s, a lot of kind of ideas and projects about what the internet should be started taking off. And a lot of money was flowing around, flying into these new businesses that were all based on the kind of the internet and what the internet was capable of and this kind of thing. And, all the mystery around that and how it could change the world and all these kind of lofty ideas and this kind of thing. And hopefully some people will start to realize there's something familiar in this. But by about the year 2000, everybody realized actually most of this stuff is absolute crap. None of it does what it's supposed to do. A lot of it doesn't even do anything, but we're throwing money at it. And that caused the dot-com bubble to burst, basically. Investors lots of money. There was a minor recession in the US. There wasn't in the UK, I don't think. But the recession in the US had a lot to do with the 9/11, September 11th attacks as well. So, yeah, my point being, there is an element of similarity in the dot-com bubble to what's happening now with AI stocks, particularly ones like NVIDIA and those kind of ones that are really creaming a lot of, investor money because based on this one narrative that everybody's holding on to. And as soon as that kind of narrative loses its luster, then, everybody just makes straight for the exit. Not just because they're like, oh, it's not going to work, but actually there's an element of, well, this has risen as much as I'm comfortable with now. I'm just going to take, some of my profits.
So it's that kind of art of the possible that has driven the boom in the price. And actually what we're getting down to now is what's the utility of this? Is that the point? It's kind of, you can have all sorts of different potential uses for this, but it's getting to the point where it's like, well, how are you going to use this and how are you going to monetize it so that mass consumers such as you and I are going to be able to buy into it? Is that the point?
Yeah. So, I mean, without getting too much into the weeds, I mean, you get kind of broadly two different kinds of, there are lots of subsets of kinds of stocks and stocks that fit certain kind of narratives and themes. But you have the major ones are kind of growth. You have growth stocks and you have value stocks. So a growth stock is we've got this new idea. We want you to invest in it, and you invest in a growth stock for the promise of future size and scale and profitability and income. And those kind of stocks are more volatile because sometimes those things don't pay off, or competitors come into the marketplace and take off market share and that kind of thing. And then you got another kind called value stocks, where it's a well-established company, has a good dominant market share position, earns an income, pays a dividend, and that kind of thing. And what was really interesting with the tech result stuff that was coming through is a business like Apple, which we consider to be a tech stock. Its performance over the course of the sell-off, it was behaving more like a value stock. So what will happen is investors will jump out of growth because, it's, suddenly everybody's kind of piling out of the promise of future returns. And then you head towards value because value is, no, these guys are, already have the returns, they have the income, they've got the established business. And the way that Apple stock was responding to the fallout was it was like a value stock. It was actually going up a little bit despite the rest of the market getting absolutely paneled. So yeah, that was really interesting. But there's a lot of stuff going on here, basically. Um, there's not necessarily a suggestion that we are in kind of real .com bubble territory here. And I think some of the economic stuff that's going on is a little bit flaky. So, like, I saw somebody point out, I can't remember for the life of me who, but so the reason that triggered it all off kind of was the jobs report in the US, which showed kind of, worse than expected. But actually, there was stuff impacting that. Like, there was a hurricane in June in the southern US, which would have affected the report in a big way. And there's all sorts of stuff going on. But actually, if you look at past reports in like April and stuff like that, that had similarly lower numbers. These things they don't move in a straight line necessarily. So this kind of brings us to the fear and the overreaction element of it. Basically, there's a lot of that.
Yeah, I'm really struck by that at times. I mean, again, I work in comms, right? But I'm adjacent to this and see it happen sometimes. And how much it's all sentiment a lot of the time, isn't it? I mean, there's a lot of underlying concrete numbers that go into it. So I'm not saying it's completely, divorced from reality. Of course it isn't. But how much of it is a sense of fear? Always kind of strikes me how much of it is that kind of sentiment. Because you are, I suppose, predicting the future. And there are people who are doing it with far larger sums of money than I, for example, and with far shorter time horizons, which makes this more pressurized. And I suppose that's the art of it, isn't it? It's kind of reading those tea leaves and trying to get it right. And that can be very, very difficult. I do remember having my one sort of fear moment came during COVID. It's interesting that you mentioned it, where I had my SIP, as I mentioned before. At that point, my daughter wasn't here, so I didn't have a junior ISA, but I did look at my SIP at one point straight after the lockdown, and it was murder on the dance floor, red everywhere, and I had a wobble. It's like, what is going on here? All my sort of gains have been wiped out for the last 5-10 years, whatever it was. And so I phoned a friend of mine who is a qualified investment advisor, and was like, look, I know you said down the years that it's about timing the market, not timing the market. That's what he said to me. That was what the principle that he talked about down the years, and what we kind of pushed out as a sensible message in the media for many people. And he just said, look, I think you need to log off and step away from your laptop, which is brilliant advice. Because just forget about it. Life's too short. What's your time horizon? I was like, well, I'm not retiring anytime soon. Okay, well, then don't worry about it. It's sort of storm that will blow through, and you keep sailing your little ship, good ship, Chris Sip, on through this stormy water.
Chris Sip, yeah.
Sorry, and that works for me. And lo and behold, they came back. But I'd have to say, I had not a similar moment. I didn't panic because I've had that experience, but I logged on this morning to look at what had happened with my SIP and my daughter's junior ISA, and I'd lost, paper losses of over £1,000, and that's going to hurt. No matter what way you look at it, but I'm expecting it to bounce back.
So that phrase "paper losses" is really interesting. I mean, my experience during the pandemic was, and at that point, I didn't kind of. I've got my pension, and that's kind of it, really. I had a lifetime ISA, but that was in a cash because I was using it for to buy a house. But I did something really annoying. Well, not annoying, but I find it funny now.
You can laugh about it with some distance, can you?
Yeah. So basically, I worked like 2 or 3 different jobs in the course of about 4 or 5 years, at the start of my career. And obviously you build up a few pension pots. And I had these kind of little pots, and it amounted to about 10 grand or something like that. It's not a huge amount of money. But what I decided was, okay, what I'm going to do is I'm going to consolidate all of these into a SIP, so that it's all in one place. I can just manage it all in one place. I don't have to have all these different providers and that kind of thing. It's not an unusual thing to do. I'm being probably more proactive than the average person, but and I was doing it DIY. I didn't want to use a kind of a consolidator who can do it for you. It's a really good option for some people, like ones like Pension Bee, and we talked to David Henderson from Penny a while back. Really nice being able to combine your stuff that way, especially if you just don't want the hassle with it. But I picked AJ Bell because the fees were relatively low. It's easy to manage. They've got access to lots of different investments. Anyway, the consolidation, all the transfers and stuff went through, and I remember it clearly because it was 2 days before my birthday, on the 20th of February 2020. And literally, I think 5 days later, the market went to absolute hell.
God.
And because let's say I'd put 10 grand in the account, and then my kind of, your investment growth at that point was zero. Even though in my past accounts, obviously I'd grown, 5% a year or whatever it was before.
Yep.
On AJ Bell, it reflects as zero because this is I didn't send investments across. I just put cash across.
Yeah.
The market went to hell, and it is technically paper losses. Technically, never recovered as a result because it goes down, and then I haven't really contributed, and I'm sitting there, and it just is like it's been 10% down forever, basically, or whatever it is, and it has grown now, but it's sat like at a loss for ages and ages purely because of that. But actually, it was just reflecting a mistake based on the fact that I'd started investing right before the pandemic, and that paper loss, it looks terrible, but actually I'm still, miles ahead because I have a pension that's got money in it, basically. Anyway,
this is the mental gymnastics, isn't it, that we have to do sometimes, is to look at it and try and think behind the numbers. But that isn't immediately easy when you're confronted by a big red figure on a thing saying, you've lost this much. You have to quell that sort of panicky voice in your head to say, shit, I can't believe that's happened, I think it's an interesting one.
The pandemic was one thing because obviously we were in absolutely uncharted waters there, right? At one point, our the water in our house stopped working, and I was like, "Is this it? Is everything coming to an end now? Are they no longer able to keep the water on? Like, are we in like a genuine Mad Max type situation here?" And that was like.
You were out siphoning petrol out the car, were you?
Yeah, genuine what on earth is going on type stuff. But this time round, I think we're in the kind of, normal cut and thrust really of what happens in markets. And what happens is markets tend to kind of tick up slowly, have an absolute, meltdown like this, and then we'll just tick up again slowly. And the obviously idea is you want those tick ups to be higher than the meltdowns. But I think for you and I, as people who have investments and SIPs and stuff, what's the best thing we can do? Genuinely, just to keep contributing and ignore it. That's what I'm doing.
It's the time in the market thing. Although I have to say, I did think not too long ago, it's getting a bit messy, the portfolio. I think I might have too many funds. So I was like, okay, well, where do I change this, shave some things off charges? And I thought last couple of weekends ago, maybe I'll sit down and do that, and then got distracted by, sport on the telly and my daughter and, friends and that kind of thing. And then woke up yesterday and thought, probably should have done that. Might be in a slightly better position now, having taken some gains. But then also, like you said, my time horizon is another 30 odd years, right? So ultimately it's going to tick back up. I'm going to do that anyway. And the hope is that if I'm drip feeding my money in, which I do on a monthly basis, I'm spreading that risk around, sort of, instead of piling it all in at a market low or a market high or whatever, I'm kind of getting the ups and the downs as we go through. And that's going to end up with me in a better position, and means that I don't drive myself mad looking at trading screens or anything else like that, because I haven't got the time, B, haven't got the confidence, although, I'm probably more confident than most about it. But, I don't even do stocks. I do kind of like mutual funds as my thing. I think I like to spread my risk that way, spread it geographically, spread it in terms of sectors, that type of thing. So when there's a mass event like this, which affects all of it, that can be a little bit disconcerting. But again, I just think about the time thing. Of course, if I was retiring tomorrow, I might have a different take on that. And that's where advice comes in. And if you need that money tomorrow, then you do need to speak to a professional, right? And get an idea about what you do in the lead up to that to start to manage your risks.
Yeah, I'll put the little disclaimer in at this point in the podcast. Obviously, we aren't investment professionals, and we're not giving out financial advice. So, anybody kind of with questions about this kind of stuff, need to do research. And anybody with more kind of complicated questions, think about getting something like financial advice. Particularly if you're coming to kind of the end of your saving journey and you're looking at retirement, that kind of thing. It's probably a good idea. From my perspective, I mean, I keep things very simple on mine. I just have everything in kind of a worldwide index fund. It's cheap and cheerful, and just forget about it type thing. But yeah, I think it's best just to not pay too much attention to it, basically. And I always find that the stuff that tries to get you to pay attention to it, so the more that they want you to log on and look, is the more the ones who are looking to benefit from you doing, regular trading or something like that kind of thing. And it's not necessarily going to be in your best interest to be panicking and paying, and getting rid of stuff, when actually it's just like, just forget it, don't look at it. I mean, my SIP I'll look at maybe once every 6 months, probably.
Oh, you're better than me. I check it at least once a week, but more because I think it's part of my job as well. To get, well, part of yours as well, don't get me wrong, but more kind of like, I am interested in the impact it has on me psychologically and the triggers that get me to think about these things and the journey and things like that. So I'm getting into the weeds of what I do, but yeah, I do like to use these things and see how I feel along the way and what news does to stimulate it and try and interrogate that personally, which is important. And also, it's a nice, we said before, it's a nice sort of, it's a release of dopamine, isn't it, to see things going up. It's obviously the opposite when it's nosediving this week, but it's about keeping it in perspective, right?
It is interesting. I mean, have you had any communications from kind of financial firms in terms of that you use a customer saying anything about this kind of stuff?
No, actually, I haven't yet,
really,
but I haven't seen anything come through.
No. Because advisors used to complain, didn't they? There was I'm not sure if the rule's still there. I think they might have done away with it after Brexit, but they had a situation at one point where if a customer portfolio took a 10% hit or something like that, then they would have to write a letter or
I do remember that,
communicate. And advisors were up in arms because it's like, our customers are all absolutely panicking because we're being forced to communicate to them that their portfolio is getting hammered. It's like, this is something that happens, kind of thing. And I think they've done away with it now. I can't quite remember, but I think actually not having kind of panicky messages being like, "Oh, markets are down," here's what you should do, kind of thing.
Don't press the red button. Says letter with big red button. Bang.
You'll see anybody who's got kind of any responsible voice in the industry will be saying, just don't worry about it. Basically, don't get into the bogged down in it, kind of thing. So yeah,
bury your head in your hobbies, Ed, eh?
Yeah, exactly. Far too busy doing hobbies, which is the what we were going to follow up on.
Yes, exactly.
That was a beautiful segue, Chris. Thank you.
Well, not quite. Bit chunky. You come to expect that, listeners, about this. It's not the smoothest of.
This is what I've been spending my money on recently. Maybe that's what we need to segment. What I've been spending my money on recently. Expensive hobbies. I know you've got an expensive hobby. Do you want to talk about yours first?
Yes, I have. I don't know if I'm going to alienate most of our listeners on this, but anyway, let's go for it. For my sins, Mouthy Money listeners, I am a very, very big Liverpool football fan, and have had a season ticket up there for quite a long time. And until the arrival, my daughter was quite religious about it, travelling around Europe and things like that. Obviously based down in London, so I can hear the sneering from certain quarters, but that meant that I was getting kind of trains up and things like that. And we're at that stage now where season ticket renewals have kind of been done and now fixtures are out and you're sort of thinking about what games you can make and which ones you sell back to the club and get some money back. So it's with Liverpool, it's not necessarily the ticket, although the ticket prices have gone up, which has caused consternation up there, which is the issue. Although it's not cheap, let's be clear. But actually, the major thing for me, which is a real drain on my kind of monthly thing as we go into this sort of 9-month period of a football season, is the train fares. It's a real pain in the posterior. And I mean, anyone who's tried to book a train recently will know that it's painful. And the amount of time I've paid north of £100 on a journey and ended up sitting on the floor with somebody's elbow in my head because they haven't run enough trains or there isn't a carriage going on or they just don't really care about your comfort or making it a nicer customer journey is astounding. So, I'm looking forward to the games. I'm looking forward to spending time with friends. I'm looking forward to picking and choosing my games a bit more because, I've got one on the way very shortly, and I've got a 3-year-old. Although my wife is incredibly understanding of that hobby, I think even before Christmas, are going to limit the number I go to. But actually, it's that. The other thing that really kind of grinds the gears a little bit is the TV thing. And you only kind of notice it when you're trying to navigate yourself around paying for these train fares. But they don't tell you the Premier League fixtures until 4 weeks in advance. So they're in the diary, but they move them for TV, particularly for clubs like Liverpool, obviously high profile. And I suppose that's a first world problem in terms of results. But yeah, it's really, really painful. Because you can't go far enough in advance to get a proper deal. And then when you do, everybody who's travelling, and if we play a London club, it's crazy. So
I'm gonna give you a money saving tip here now, Chris.
Go on, Ed. I need all the help.
Take the megabus more.
The megabus, I'd rather walk. No offence, megabus. But somebody I went to university in Manchester,
now, and they're going to be really upset about this.
Ed's a fan. I've never. To be clear, I've never got a megabus. But I did used to get the National Express when I was a student up to Manchester.
That's not bad.
5.5 hours.
Yeah, they do. You'd think that between like the big city centres or something, they'd do like an express bus or something like that.
Yeah, stopping at every place on the way. No, I think those days are gone, Ed. I think I'd rather. At the risk of sounding a little bit too
do they not do
profligate?
Do they not? Can you not get like a fan bus? Surely I see that in films.
They do have that. Yeah, they do have that. But I'm complaining here. I do have a couple of friends who drive, and that saves things. We split the petrol and things like that. So there's ways around it, don't get me wrong. The other thing is hotel rooms. So if there's a Champions League game or something, and I stay overnight, then I've got my own little hack, which I won't say, but I stay a lot further out of town, near where my family are based. But if you want to get a city centre hotel, prices in these places go absolutely astronomical, right? Because they can. So yeah, that's it is painful.
The train line. I mean, we've never actually talked about this, funnily enough. But I mean, I live out in the kind of wilds of North Devon, where I mean, our nearest train line is just it's basically useless because it would just be quicker for me to drive. It would be quicker and cheaper for me to drive. But obviously, I have to come see you guys in London, every now and then, and so our choices are. So I have like an hour's drive to Tiverton, and this is a big thing on LinkedIn recently. There was a person's post had a big thing about the railways in the southwest. This is a very southwest concern, but bear with me. So you go to Tiverton and you get GWR, and it'll cost you 200 quid for a return ticket. I mean, it's just absolutely, it's completely
anything on peak is completely ridiculous. It's like
it's insane. If I drive another 20 minutes down the road to Honiton, which is on the SWR line, it cost me 50 quid. And this is what I don't understand about the train system and how it can work like that, where the price differentials, depending on the line you're on, are just unbelievable. It's like the GWR are behaving like they're a luxury line, but they're not. It's just a train line, right? And you get on Southwest Rail, and it's just kind of the same. I mean, the carriage is maybe a little bit older, and it takes longer because it stops at more places. I don't get it. I mean, I'd be interested to see what Labour do, because obviously I think they are going to tinker heavily with the railways. But
I think the time has come for that, definitely. Yeah. Mick Lynch had a good rant about it not too long ago, about how they've taken on a lot of all the upside, a lot of these companies, but not the downside of investing in making it sustainable and better. And I kind of understand that without getting too much into it. I don't get too political, but I'm sure Mick Lynch is not that popular with all of our listeners. But I think he talks a lot of sense at times about things like that, and they do need to look at it because it's gone too far the other way in terms of being not
Liverpool and Mick Lynch fan. You're really setting your stall out today, Chris, aren't you?
I'm not as far as that, but I'm centre left is how I describe myself. Ed. But no, as somebody who sat on the floor of what feels like at times it's not crumbling. That's not fair, but a non-functioning railway thing. You're like, okay, come on, guys, we do better, surely. Particularly as we need to encourage people to get off the roads and find alternative means of transport. And I know we had HS2 in the mix, and it feels like that's gone by the wayside. And talk about the Northern Powerhouse or whatever, but there is a big infrastructure thing that needs to be done here. There needs to be more competitive pricing, full stop, whether it's Mick Lynch or
Labour cancelling railway lines, though, left for new railway lines left, right and centre. I'm not sure what that message that sends. I don't know.
That's true. It'll be an interesting one to watch because, like you say, it does feel like something that just annoys people on a daily basis.
Yeah.
So, there's other more pressing priorities, but it's got to be on the list somewhere.
Mm-hmm.
What's your expensive hobby, Ed?
Yeah, we was going to say we've got a minute tangent here. I want to talk about my hobbies too. So I'm really into photography.
Right.
When I was young and single and I had disposable cash, I used to buy expensive digital cameras and this kind of thing.
Oh.
And I mean, they get really expensive really quickly. And I used to spend, I'd probably more money than I was sensible on it. I mean, the most expensive camera I ever had was about $2,000, which is expensive.
Was it good though?
Yeah, I mean, obviously it was amazing. I mean, I used to earn a bit of extra sideline income taking photos, and I used to go to like protests and stuff. I'd get good pictures of politicians and that kind of thing. It used to be quite good fun. Anyway, I sold all that stuff off after I met my now wife because I kind of just stopped doing it because I was not young and single and I didn't have as much free time. Basically, started getting back into it though, but I can't afford an expensive digital camera anymore. We've got a son, I've got a mortgage, I've got more important things to do. So I've been getting into buying cheap cameras on eBay.
Okay.
As I sit here, I've got three. Yeah.
Right. Because one's not enough.
Because they're film cameras, right? So if you want to shoot in black and white, you need a different camera to put the black and white film in, and then you see. Anyway, I've managed to pare it down. I've got this absolute beast. You can't really see it on the camera. There you go.
Oh yes, yeah. Canon. Look at that.
Yeah. This cost me, well, not the lens, because the lens is more expensive. It cost me £35.
Wow.
Decent. For a camera that has many of the like qualities of a full professional digital camera. You just have to put film in it instead, basically.
Brilliant.
Now, where this starts getting expensive is you still have to develop the film somewhere, and you can't take it to Boots anymore, really.
Do Boots not do that anymore?
You can, but it takes like 3 weeks or something. You have to go to Germany.
Germany?
Yeah, Germans. They're the only ones who develop film on an industrial scale.
Right.
I don't know what the Germans are up to, but they're still up to it.
Okay.
But I found a little. So you basically, it's very weird, and this is marking me out as such a hipster thing to do. But you get these like weird little basically like artisanal film developing studios around the UK.
Amazing! I can picture them now. I
found a really good one.
Yeah.
I found a really nice one in Leeds called like Take It Easy or something like that. And it's like, they're like, we're a collective of photographers who really love shooting film. And we got together and decided to start developing, all this kind of stuff. I mean, it's really nice. And you send it away. So the film is annoying. It's pricey because you end up spending about £12 on a roll of film. And then you spend probably about another £12 developing it. So actually.
How many shots do you get on a roll, Ed?
So 36 for a big roll. But I will say, right, because when you have a digital camera, and I remember when I had digital camera, so this is getting into photography chat, there's not even money chat anymore, sorry. You would just kind of, hold your finger down, take lots of photos. A digital photo costs nothing, basically, to take. And it's the same with your phone. You take lots of photos. I have millions of photos on my phone. I never look at any of them, that kind of thing. With a film camera, you really have to be extremely efficient and economical with your photography. And I find that it's forcing me to be better, basically, because every shot has a cost, and that's probably the best part of ATP or something like that. So that's my expensive hobby.
Well, it's good actually, and we got round to the finance in the end there. But you're right, if it focuses the minds, the cost of it, then it's good. It might make you a bit more discerning and a bit more worried about the quality of the shot that you get, which might improve you as a photographer. I don't know, photography is not my thing, but it sounds like it's good.
Yeah, I'm getting back into it. People can check out my Instagram if they're interested in that.
You want to plug it now?
I think it's just Edmund Greaves. I don't know,
Well, put it in the show notes.
I'm not plugging. I'm here to plug Mouthy Money. All right, Chris. Just be cool. No, I'm joking. That's my expensive hobby. I've been through quite a few. I mean, I'd call climbing Kilimanjaro probably was an expensive hobby for about a year because I had to buy all the gear and all that kind of stuff. But that was basically temporary. So
we did a podcast on that as well, didn't we? If listeners want to hear about that, go back through the back catalogue.
Go back to the back catalogue. We did that in, it must be March now.
If anyone's planning on climbing a huge mountain anytime soon, Ed's got you covered on how to do that. What planning you need to do, that kind of thing. So yeah. Right,
Chris. Let's polish it off there. I think it's been another interesting one. We're going in a slightly different direction today with investments and stuff and hobbies.
Yeah, don't panic, everyone. Go out and take pictures or watch a football match and don't worry about your portfolio. Although that's not financial advice.
That is not financial advice. Absolutely not. All right. Thanks everybody for listening. You can catch us on Spotify, YouTube, Apple Podcasts, and then of course we're all across socials, TikTok, Instagram, all that kind of good stuff. And you can catch the Mighty Money website and newsletter as well. So thank you everybody. Thank you, Chris.
My pleasure.
And goodbye.